such as utilities, and financial enterprises, such as financial institutions, Yeah, that's what you call a GB, a government business enterprise. Now, write e.g., KPLC, KPL, KRA, etc. Now, that's what you call a government business enterprise, a GBE. Now, let's look at characteristics of a GBE. Characteristic of a GBE. Yeah, what is a characteristic of a GBE? Number one, it's an entity with power. It's an entity with power to contract on its own name. It's an entity with power to contract on its own name. Yeah, for example, if you are to be given a contract by CASNEB, let's use an entity we know. Yeah, also CASNEB give out tenders. If you are to be given a tender, what can you supply to CASNEB and make some cash? Stationery. Yeah. The question paper, the answer sheet, yeah, they contract a firm. So in case you enter into a contract, you'll not enter in relation to the government of Kenya. It will be a contract between me and CASNEB. That's what we call a GB. That means it has the power to contract on its own name. Number two, has been assigned the financial and operational authority, has been assigned the financial and operational authority to carry on a business, Number three, sells goods and services, in the normal course, sells goods and services in the normal course. Number D, is controlled by a public sector entity. Is controlled by a public sector. Entity. Good. So those are some of the characteristics of a GB. So now let's look at something else. The general government sector. GGS. Where do we see that? What do you mean by a GGS? General government sector. Now, when we talk about a GGS, we are talking a given ministry. Can you write that? In bracket, ministry. It's like a ministry. Where do we see that? A GGS comprised of all organizational entities. A GGS comprise all organizational entities of the general government, as defined in statistical basis of financial reporting, in bracket, both national and county government, You see, you're saying that it comprises of all organizational entities of the general government. When you talk about the general government, that's all about the national government and the county government. Then you write to see that. GGS, it's a group of government-controlled entities. GGS is a group of controlled entities that provide services to the members of the public. that provides services, to the members of the public, to the members of the public, to the members of the public. Good. So now let's look at something else. Disclosure requirement, disclosure requirement, disclosure requirement in respect of GGS, disclosure requirement in respect of GGS. So you can write in bracket, content of a GGS report, content of a GGS report, content of a GGS report. Yeah, when you're presenting the report, and this one mostly is presented either to the president or either to the National Assembly, the members of the public. I mean the members of the parliament. Yeah, so what are some of the items that need to be included in this report? Number one, revenue by major class, revenue by major class, revenue by major class. When you talk about by major class, you know, we have various categories of revenue. We have what we call operating income, non-operating income. Number two, expenses by major class, expenses by major class. And we have various categories of expenses. We have operating expenses, yeah, such as financing cost, selling and distribution, admin expenses, cost of sale, etc. Number four, assets by major class. Yeah, either non-current or current assets, assets by major class. Another one, liabilities by major class, liabilities by major class, liabilities by major class. Another one, accumulated funds, stroke net assets, stroke equity, accumulated fund, stroke equity, stroke net asset, stroke net asset. Another one, reserves. Another one, cash flow from operating activities, cash flows 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 from operating activities. Another one, cash flows from investing activities, cash flows from investing activities. And lastly, cash flows from financing activities, cash flows from financing activities, cash flow from financing activities. Good. So now that's all about in the GGS. Now let's look at approaches. Approaches used to determine value in use and impairment errors of non-cash generating assets. Yeah, what are those approaches you can use to determine the impairment loss or the value in use? Number one, we have what we call replacement cost. Replacement cost approach. Number two, we have what we call restoration cost approach. Restoration cost approach. Then lastly, we have what we call the service unit approach. And those are the three approaches you can use to determine the impairment loss in case of an uncash generating asset. Let's start with the first one, a depreciated replacement cost approach. Depreciated replacement cost approach. Depreciated replacement cost approach. Under this approach, comma, the present value of the remaining service potential, the present value of the remaining service potential, the present value of the remaining service potential of an asset, will be determined as a depreciated, replacement cost, as a depreciated replacement cost as follows. So how do we determine that? Huh? So now let's be here, don't write. So you'll take the cost of the asset, then you deduct the accumulated depreciation. If you take cost minus depreciation, you get the net book value. And you see that that net book value is what you call the carrying amount. Then you see that an asset is said to be impaired if the carrying amount exceeds the recoverable amount. So how do we get the recoverable amount? So to get the recoverable amount, you take replacement cost. If you are to replace now, how much will you incur? Then you raise depreciation. Now for this depreciation, use the same terms as the depreciation for the old asset. And that's how you get the recoverable amount. So how do we get the impairment loss? To get the impairment loss, you take the carrying amount, that's A, you raise the recoverable amount. Now you can show that. So I want us to do an illustration. May 2014. Question 5A. Question 5A. May 2014, question 5A. Others to search for December 2013, question 5A. Can also search December 2013, question 5A. Yeah, there is a reason why I said May 2014, question 5A. Because some question, that's why it is, depending on how it was arranged. But now that the original question should be December 2014, question 5A. Based on how your paper are arranged, if you find it from May 2014, question 5A, just write like that. If it's December 2013, question 5A, still okay. Are we there? In 1993, hoping we are there. Now that's the question I'm doing. I said question 5A. So we are told that in 1993, now before you do that, can you go to part B of the question? Let's go to part B of the question. Now, IPSAS 22, disclosure of financial information about the general government sector, defines a general government sector as comprising all organizational entity of the general government as defined in statistical basis of financial reporting. With regard to this standard, outline 8 items that should be disclosed in respect to GGS. Which are those items that need to be disclosed in addition to GGS? Go and confirm from your notes. Yeah. You have them, and you see it has how many marks? 8 marks. Good. So now let's go to part A of the question. That's my objective. In 1993, the Nairobi County government constructed a public primary school at a cost of 25 million. So the cost of the asset was 25. So we are talking about the government school. So that's what we call an income generating asset. It was estimated that the school will be used for 40 years. By the end of 2013, that's after how many years? From 1993, 2013. That's after 20 years, right? So how much is the depreciation at the date of assessment? So the cost was 25. The estimated economic life was 40, but now we are assessing after 20 years. You multiply by 20, that's the half. So it will be 12.5. So how much will be the carrying amount? 12.5. Good. We are told that by the end of 2013, the school population had declined from 1,500 students to 400 students as a result of population shift caused by the bankruptcy of a major employer in the area. The management decided to close the top 2 floors of the 3-story school building. The management has no expectation that enrollment will increase in the future, such that the upper story would be reopened. The current replacement cost of the school is estimated at 13. The replacement. If you have to replace now, it will cost us 13 million. So replacement cost is 13. Then you raise depreciation. I say that when determining the depreciation, use the same policy as for the old asset. So you'll take 13, you divide by 40, you multiply by 20. So what do you get? 6.5. So how much will be the recoverable amount? 6.5. You call it B. Now, to get the impairment loss, we compare the carrying amount against the recoverable amount. So you take A minus B, you get an amount of 6 required. Calculate the impairment loss to be recognized using the depreciated replacement cost approach. Now, that's the amount of the impairment to be recognized using that approach. So before you copy, let's do another illustration. December 2014, question 5. December 2014. Question 5B, part 1. B, part 1. So kindly let's stop writing. I'll give you time to write. You take the cost of asset, you raise depreciation, and that's how you get the carrying amount. And then you take the replacement cost, you raise depreciation to get our recoverable amount. That's how you get the impairment loss. Now let's start with part A of the question. Part A of the question. Part A, I told that with reference to IPSAS 26, impairment of non-cash generating assets. Number one, explain the meaning of cash generating asset. Cash generating asset. What's a cash generating asset? See that the asset held to earn commercial returns. Number two, analyze the criteria that could be used to identify an asset might be impaired. Another 8 marks. Criteria that could be used to identify that an asset has been impaired. Let me make your work easier, as I always do. I gave you the indicators of impairment loss. How can you assess that an asset has been impaired? And I give you internal indicators and external indicators. One of the external indicators was reduction in the market value of the asset. There were significant changes with adverse effect to the entity's asset, such as technological advancement. Also significant increase in the interest rate, in that those rates will affect the value in use. I also give you the internal indicators, physical damage of the asset, and then also evidence of internal inefficiency. Now that's upon you now to determine how to do with that information. You see, that's how many marks in total? 12 marks, including part A. 12 marks. And you see most of the students, they only focus with calculation. So you see this, in this case, if those are 12 marks, that means the other part of calculation has only 8 marks. 8 marks. Don't ignore any theory that I'm teaching in my class, because that's what most students do. And they ignore, these are math unit, so I focus on math. What about the theories? Theory is what will save you. Let's do B part 1. On 1st of January 2009, the government purchased a software license for $350,000 for an application on its new mainframe computer. So the cost was $350,000. Then we are told that the government estimated that the useful life of the software would be 8 years, and that it would receive benefits and service potential from the software on a certain basis of the useful life of the software. As at that 1st December 2013, that's after how many years? Engage your fingers. That's after how many years? I said you engage your fingers. 5? Good. Let's get depreciation. The cost was $350. The estimated economic life was how many years? The estimated economic life was how many years? 8 years. And then we are assessing after 5 years. So you multiply by 5 now to get the accumulated depreciation. How much is that? $218? $750. So that means at the date of assessment, how much was the carrying amount? 131 to 50. You call it. We proceed. We are told that as at that 1st December 2013, usage of the application had declined to 15% of its originally anticipated demand. A license for a software application to replace, that's what we call the replacement cost. A license for software application to replace the remaining service potential of the existing software application would cost how much? $150. If you have to replace now, it will cost us $150. So take the replacement cost, which is 150. Then you raise depreciation, assuming the same policy of the old asset. So it's 150,000. Estimated economic life was 8 years. Then the same period, assuming we are assessing after 5 years. So how much would be the accumulated depreciation? Sorry? 90? 750. Now give me the carrying amount. You get an amount of 56? 250. Good. Now let's get the impairment loss. You take the carrying amount minus the recoverable amount, 75,000. Required impairment loss to be recognized for the software using the depreciated replacement cost approach. They always specify which method to use. So now you can copy. Second approach. Second approach. That's the restoration cost approach. Restoration cost approach. Restoration cost approach. Did I see that? Under this method, comma, under this method, comma, the service potential of an asset, the service potential of an asset, the service potential of an asset to its impairment level, to its impairment level, to its impairment level, to its impairment level, will be the present value, will be the present value, will be the present value of the remaining service potential, will be the present value of the remaining service potential, the remaining service potential determined by subtracting the estimated repair cost, by subtracting the estimated repair cost stroke restoration cost stroke restoration cost from the current cost, from the current cost of replacing, from the current cost of replacing, from the current cost of replacing. So that by subtracting the repair cost stroke restoration cost of the asset from the replacement cost. Now, how do we determine the impairment loss? So it's determined as follows. 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 So you'll be taking the cost of the asset, and then you just depreciation, and that's how you get the carrying amount. Then to get the recoverable amount, you take the replacement cost, then you just depreciation. Now what you get here is now what you call depreciated replacement cost. Replacement cost. And then you raise the restoration cost. Restoration cost or the repair cost. It's, for example, assuming that you have a vehicle you want to replace, and this vehicle was involved in an accident. So for you to fetch the maximum value, will you set it on that state, the damaged state, or first of all, you have to repair? You repair, good. So in that case, that's why we need to take into account the not replacement, but restoration. Oh, yeah, restoration cost. Now, once you raise the restoration cost, now you get the net selling cost, of which now that's what we call the recoverable amount. That's the. So how do we get the impairment loss? So to get the impairment loss, we compare the carrying amount against the recoverable amount. You can show that. June 2012, question 5B. Let's start with part A of the question. Part A of the question. With reference to IPSAS 21, impairment of non-cash generating assets, explain the following terms. 1, government business enterprise, that's GBE. Do you have that? Yes. Number 2, carrying amount. What's carrying amount? Financial statement. Sorry? Cost minus? That's net book value, of which you are correct. You know, carrying amount. What about liability? You take the cost of liability minus depreciation. Remember, you said that the carrying amount is the amount of an item. I never said an asset. Are you together? Amount of an item shown in the financial statement. I used cost minus depreciation so that you can understand what is it. Same as net book value, but that it does not necessarily mean the net book value. So the carrying amount is the amount of an item shown in the financial statement. Number 2, recoverable service amount. Let me make it easier. Remove that word service. What is recoverable amount? Good. Is the higher of. Are you together? Is the higher of. The fair value less cost to sell and the value in use, correct. Those are 6 marks. Now let's go to part B of the question. Part B. On 1st of January 2006, Matopeni Primary School acquired a bus at a cost of 6 million to enable the students from a nearby village to commute to school free of charge. So the cost of the bus was 6 million. The school estimated that the bus had a useful life of 10 years. On that 1st December 2010, that's after how many years? Engage your fingers. 5 years. Those are 5 years, right? Good. So now let's get depreciation at the date of assessment. The cost was 6 million. The estimated economic life was 10 years. Now we're assessing after 5 years. That's half of the economic period. So depreciation will be 3 million. That means the carrying amount will be 3 million. On that 1st December 2010, the bus sustained damage in a road accident, requiring 1.2 million to be restored to a usable condition. We need to restore. That means we need to repair. We'll have to incur a cost of how much? 1.2. The restoration did not affect the useful life of the asset. The cost of a new bus. The cost of a new bus. What does that mean? If you are to replace this bus now to buy a new one, we are told that the restoration did not affect the useful life of the asset. The cost of a new bus to deliver similar service, that was, it's 7.5 as at that 1st December 20. So replacement cost is 7.5. Then we have depreciation. It's 7.5. Same depreciation policy, right? 10 you multiply by, you get 30. 37.50. Now what you get here, This is not now the recoverable amount. You get an amount of 37, but for you to get this 37.50, first of all, you have to repair that vehicle at a cost of how much? 1.2. So now give me the net. That's what we call the fair value less cost to sell, or the value in use. You get an amount of 25.50. Good. So the carrying amount is 3 million. The maximum we can recover is 25.50. So that means there was an impairment loss of how much? 450. Let's go to the requirement. Required. Evaluate the impairment loss attributable to the bus using the requirement of IPSAS 21. Now it's IPSAS 24. Impairment of non-cash generating assets. Use the restoration cost approach. Good. Before you copy, you do the previous question, December 2014. Question B, now we do part 2. December 2014. Question 5B. In most of the cases, IPSAS will be reserved. Always question number 5. Question 5, part 2. We are done part B, part 1. Now, part B, I told that. So first of all, the format does not change its cost. You raise depreciation, you get the carrying amount. Then you take the replacement cost. Then you raise depreciation. Then you get depreciated replacement cost. And then you raise restoration cost. And that's how you get now the recoverable amount. Then how do we get the impairment loss? We take A minus B. So I told that on 1st of January 2004, the government built an office at a cost of 50 million. So the cost of the office was 50 million. The building was expected to provide service for 40 years. That's estimated economic life. On that 1st of December 2013, after 10 years of use. So how much is the depreciation? 50. The estimated economic life for how many years? Then we're averaging after 10 years. 50 divided by 4, you get 12.5. So we'll get an amount of that 7.5. That's the carrying amount. Yeah, we told that. On that 1st December 2013, after 10 years of use, a fire caused severe structural damage, and due to safety reasons, the office building was closed for repairs. That cost 35.5 for repair. That's the restoration cost. The repair were made to restore the office building to occupiable conditions. The current cost of a new office building is 100 million. The current cost. So to replace, that's the replacement cost. It will cost an amount of how much? 100. Then you raise depreciation, you take 100. Estimated economic life was 40 years. Then you multiply by 10, and that's 25, right? So how much would be the depreciated replacement cost? 7. But for us to get this 75, we have to repair at a cost of how much? 35.5. You get an amount of that 9.5, right? Is it not 9.5? Can you confirm that? That's 9.5. That becomes your recoverable amount. So give me the impairment loss. You take A minus B. You get negative? Yeah. So are you together? There is no, let me take you back. We say that an asset is said to be impaired if the carrying amount exceeds the recoverable. When the carrying amount is more than the recoverable amount. In our case, the carrying amount is at 7.5, recoverable amount is at 9 point. So the asset has not been impaired. Are you together? There is no impairment of negative. Are you together? Yeah, actually, that too should be recognized as part of revaluation. Good. You can copy now. Impairment gain. There is nothing like impairment gain. There is nothing in accounting like impairment gain. Are you together? Not unless you mean impairment reversal. But you see, you are not told that this asset has been previously been impaired. Are you together? It cannot be an impairment reversal. So in short, the asset was not impaired. Impairment loss is 0. For accounting purposes, that too should be taken as part of the valuation. That method, service unit approach. Service unit approach. Service cost approach. Let me say that. Under this approach, comma, the present value of the remaining service potential, the present value of the remaining service potential, the present value of the remaining service potential is determined by reducing the current cost, is determined by reducing the current cost of remaining service potential. It's determined by reducing the current cost of remaining service potential, of the asset, of the remaining service potential of the asset before the impairment, Yeah. What does it mean? Now, in this case, we are saying that when determining the value in use, you only take into consideration the present value of the remaining service potential. There's a question we had done, the first question, the second question we did, where the production reduced by 20, was it 25 or 15%? 15%. Eh? That means the value of this asset at 100%. In that method, we are using the depreciated cost, replacement cost approach. But for the service unit approach, in this case, we don't impair the asset at its full capacity. If the production reduced by 15%, that means we're only getting the benefit from the remaining 85%. Now, this is what we consider now in our service unit approach. Good. June 2013. June 2013. Question 5B. June 2013, question 5B. Yeah. We start with part A of the question. Part A of the question. With reference to IPSAS 26, impairment of cash generating asset, explain the meaning of the following terms. Number one, value in use. What is value in use? What is value in use? Present value, right? I thought by now those definitions should be at your fingertips. What is value in use? Present value of the future cash flow from the remaining service potential of the asset, right? Yeah. Number two, recoverable amount. What is recoverable amount? Is the higher of, right? And once you know that is the higher of, yeah, is the higher of the fair value less cost to sell and the value in use. Let's go to part D of the question. Part D. The International Accounting Standard Board, that's IASB framework requires that a useful set of financial statements should be reliable. That financial statements should be reliable. Explain 5 qualities of financial statement that makes them reliable. qualities of financial statement that makes them reliable. Don't expect me to teach you that one in class. Yes, that one is not part in our notes. John Mark didn't teach us that one in class. We want 5 units. Not units, 5 points. And it's hard for you to generate only one. What makes financial statement to be reliable? If it's audited, that's correct. You see, if you have two set of financial statements, one which is unaudited, the other one which is audited, which one will you more rely on? The audited. Good. I'm not giving you any point. I want you to generate all those points. Should be at least 10. Here we just require 5. Sorry? Timeliness, that's correct. That for information to be reliable. Assuming you're an investor, you want to make a decision whether to buy share or not to buy the shares. But now the information given is for 1999. Will you be able to make a decision based on that? No, you look at the timeliness, or what we call, what's the other name for timeliness in financial, in accounting? Relevance. Are you together? Or it relates to what you want to know. Number one should be understand. Standardized. Try to put your in place. Yes, that means it has complied with the requirement of the standards. Are you together? Yeah, you have the financial statement, but the way they are presented, this accountant has started with non-current liability, followed by current liability. Then under equity, non-current assets. So automatically you know that this information is not prepared by a professional accountant, right? Yeah, so something that has followed the standard. Accurate. You cannot write information which is not accurate. Completeness. You are given a balance sheet where it has not balanced. You're given a current asset, some are dashes. Then you have the equity, under equity, ordinary share capital, and current liability is dash. So you need something which is complete. You had a point? Sorry? Consistency. But you see now consistency. In this case, we want to make a decision based on one information. You are not conducting financial analysis of that's what you apply consistency when it comes to what we call trend analysis. You are comparing this against a given period. But in this case, you're only dealing with financial statement for one period. What makes them to be reliable? Prepared by, after all, that's why they're asking about what makes financial statement to be reliable. Are you together? Who prepares the financial statement? They are professional accountants, right? Yes. Good. So now let's go back to part B of the question. Part B, I told that on 1st of January 2018, Mashabani County Education Department purchased a printing machine at a cost of 40 million. So we have the cost was 40 million. Now we raise depreciation for it to get the carrying amount. Once you get the carrying amount, you take the replacement cost, then you raise depreciation, and what you get is what we call the depreciated replacement cost. And then how do we get the recoverable amount? Once you get the recoverable amount, now you can be able to determine the amount of impairment loss. Read that question again. We told that on 1st of January 2008, Mashabani County Education Department purchased a printing machine at a cost of 40 million. The department estimated that the useful life of the machine would be 10 years. On that 1st December 2012, that's after how many years? 5 years. So depreciation will be 40. You divide by 10, now evaluating after 5 years. 5 years. So that is 20. So the carrying amount will be 20. Good. So as at that 1st December 2012, it was reported that an automated feature of machine function did not operate as expected. That point itself is an indicator of impairment loss, right? What was that indicator? Umesema yes vizuri. And that's what we call evidence of internal inefficiency. It's not operating as we expected. Yeah, we are told that. On that 1st December 2012, it was reported that an automated feature of the machine function did not operate as expected, resulting to a 25% reduction in the machine annual output over the remaining 5 years of its useful life. So that means it will not be operating at a full capacity. It's not operating at 75%. So when determining out the recoverable amount, we only expect the benefit to a magnitude of only 75%. The cost of a new printing machine was 45 million as at that 1st December 2012. The cost of a new machine. So replacement cost will cost us 45. You raise depreciation. 45 divided by 10. You multiply by 5, you get an amount of 22.5. So the depreciated replacement cost will be 22.5. Let's go to the required. The impairment loss as at that 1st December 2012 using the service unit approach. You need to be very keen with the method to use, because the same question, the examiner can say that using the depreciated replacement cost approach. Using the depreciated, the 25 will be relevant. Are you together? So in this case, to get depreciation, you could have taken A, and now this one now could be our recoverable amount. But in this case, we are told that we use the service unit approach. So of this depreciated replacement cost, 22.5, remember now machine is not operating at a full capacity. So there was a 25% reduction. So therefore you only get the benefit from 75. So 75% of that is how much? 875. That's now what we call the recoverable amount. Now give me the impairment loss. Get an amount of 3.125. Good. Can copy that. And then you do this question now. I want to give you an assignment. You do it now. November 2019. Question 3B. Yes, I'm coming to Mark. November 2018. Then I want to give you an assignment. Before you do that one you do it now. Then take out your handout. Handout page 43. Handout page 43. Now, this is our next topic. So, handout page 43, I want you to go and copy the following. Kindly, make sure you copy by next class. So, you copy that up to where you have the employee benefit. Don't copy employee benefit. That's another topic. And it's just that one page, yes? Yes. She lost her handout. Just copy that. Kindly make sure you copy that by next class. So because I won't dictate, so I want us next class, what I'll do, I'll spend only the first 10 minutes to explain what's a financial instrument so that we can do as many illustrations as possible. So that's upon you now. So do this now. Once you are done with this, we still have time. You start copying so that by next class you have everything.